Sir, very happy evening to all. I believe that your preparations are going very well. There may be two categories will be there whose preparation is going very well and someone may get little bit of tensed. If you are getting little bit of tensed, the good medicine is revise the areas what you already know. If you are feeling any sort of tension in direct tax, to reduce your tension and pressure, I will be solving a 6-mark area, a very simple question, part B question, which is from double taxation avoidance agreement. Mr. Mani Prasad, aged 71 years, furnishes the following information in respect of income earned by him for the previous year ended 31/3/2024. They have specifically given an age of more than 60 to say that the assessee is a senior citizen. Fine. In India, he has earned pension from state government 4,80,000. That means this income should be taxable under the head salaries. And my dear lovable students, as per the default tax regime 115 BAC route 16 subsection 1A, standard deduction is allowed. Now we can reduce that 50,000 and balance will only be taxable under the head salaries. Short-term capital gain on sale of plot, that means normal rate will be applicable. Deposit in PPF account, if you are traveling through 115 BAC route, ATC not allowable. Speculative income will be taxable under business income. From country M, agriculture income, since agriculture land is not situated in India, it is not exempted under section 10 subsection 1. Dividend from a company incorporated in country M, gross, it is exempt in country M, but it is not exempt in our India. So it will be taxable in India. This will be taxable under the head IFOS. From country N, business loss. It is a proprietary business not eligible for set off against other income in country N, but our country is having a big heart. As per section 72, normal business loss can be set off against PGBP, that is intra-head adjustment. So this 1,16,000 loss can be set off against speculative income of 1,56,000. Gross rental income from house property, no statutory deduction was available in country N. There is no fair rent, there is no municipal value, so there is no expected rent, standard rent, all those information has not been given in the question. So this amount we can claim it as GAV. If there is any LT bar MT paid, municipal taxes paid in respect of above property, not allowed as deduction in country N, let it be, but our country is allowing that. So we can claim that and balance is net annual value. On that we can claim 30% of net annual value. Additional information. There is no agreement under section 90 for relief of avoidance of double taxation between India and country M and country N, where the income has been accrued or arisen. Mr. Mani Prasad is resident in India and he has paid applicable taxes on income earned in country M and country N, where the applicable tax rate are 10% and 5% respectively. Compute the total income and net tax liability of Mr. Mani Prasad after providing relief under section 91 for assessment year 24-25. Mr. Mani Prasad is paying tax under default tax regime under 115 BAC. So this is a 6-mark easy picking for examination from double taxation avoidance agreement. Sir, when a multiple country question come in examination, when you are reading that question in your working note, try to note the things like this. From India, you are having pension income. 4,80,000 rupees is the pension income. This will be taxable under the head what? Salary. And under 115 BAC, standard deduction under 16 subsection 1A of 50,000 is allowed. So 4,30,000 is the taxable salary. STCG, since it is not on account of sale, that 1,50,000 will be taxable at normal rate. Speculative income will be taxable under business income 1,56,000. So these are the income taxed from India. Coming to country M, agriculture income 86,000, that is taxable in India. Dividend, it is exempt in that country, but it is not exempt in our India, so it will be taxable under the head IFOS. And very important point you have to note here is, since it is exempt in that country and only taxable in India, it is not a doubly taxed income. For that, relief under section 91 is not possible, and average rate of tax is 10%. And country N, there is a business loss of 1,16,000. As per the law of that country, we cannot set off, but as per the law of our country, we can set off. So it will reduce the doubly taxed income of country N. That you have to keep in mind. Gross annual value 3,20,000, because fair rent or municipal value, whichever is higher, that information has not been given. Whichever is higher or standard rent, whichever is lower, that answer is called as expected rent, that has not been given. So expected rent or actual rent received or receivable, whichever is higher. So we are adopting that value as gross annual value. Clear? Yes. Let's LT bar MT, this has been paid outside India. As per that country, it is not allowed as a deduction, but as per our India, it is allowed as a deduction. So NAV is 2,99,000. On that NAV, we can claim 30%, which is 89,700. So 2,09,300 is the income from house property, and applicable tax rate is 5%. With this consolidated information, my dear lovable students, we can start solving the answer. When you read the question itself, try to read like that. Put 3 column, analyze the part by part. Since Mr. Mani Prasad is resident in India for previous year 23-24, his global income would be subject to tax in India, because in the hands of resident and ordinarily resident, global income is taxable in India. Therefore, income earned by him in country M and country N would be taxable in India. He would, however, be entitled to deduction under 91, since India does not have double taxation avoidance agreement with country M and country N, and all conditions under section 91 are satisfied. Computation of total income of Mr. Mani Prasad for assessment year 24-25. Income under the head salary. Now I am writing not country wise but head wise. Pension from state government 4,80,000. Less standard deduction under 16 subsection 1A, allowable under section 115 BAC 50,000. So 4,30,000 is the taxable salary. Very clear. Income from house property, rental income from property in country N 3,20,000. We can reduce municipal tax 2,99,000. 30% standard deduction allowed 89,700. 2,09,300 is the income from house property. Fantastic to the core. PGBP. We are having speculative business income from India. From India actually we are having income. But set off of business loss from proprietary business in country N under section 70. Because this is current year business loss, not carry forward. So we will not go to 72, we will set off under 70. So 1,16,000. So 40,000 is the taxable PGBP. There is no adjustment with capital gain, short-term capital gain. Since it is short-term capital gain, taxable at normal rate. On sale of plot in India, 3,20,000. IFOS, agriculture income from country M, not exempt, because the agriculture land is not situated in India. Since it is earned from land situated outside India, 86,000. Dividend from company in country M, taxable under IFOS. So total, the gross total income comes to 11,53,300, which comprises of salary, house property, PGBP, even capital gain and IFOS also. And we all know that under 115 BAC route, since it is a concessional rate of route, sir, chapter 6A will not be allowed. But we know that there are certain exceptions, but all those exception section has not been given in the question. So 115 BAC, nothing will be allowed. So the total income is exactly the gross total income, 11,53,300, my dear lovable students. On that 11,53,300, if you are putting back route up to first 3 lakh, basic exemption limit is nil, because here I will not respect the age of the assessee, whether the assessee is a senior citizen or super senior citizen or normal person. Such things, such classification is not there, because my dear lovable students, the assessee is going to enjoy concessional rate of tax? So straight away, sir, up to 3 lakh, nil. 3 lakh to 6 lakh at 5%, 15,000. 6 lakh to 9 lakh at 10%, 30,000. 9 lakhs to gap till 11 lakh 53,500 at the rate of 15%, 37,995. If you put the total 82,995 on that, health and education cess at the rate of 4%, because since the total income does not exceed 50 lakhs and all, we are not going to see the surcharge and all. So 86,315 is the net tax payable. So 86,000 is the tax payable in India for a total income of 11,53,300. So into 100 if you put, you will get 7.484% is the average rate of tax in India. But whereas in first country the average rate of tax is 10%, so Indian average rate is less, so the rebate will be restricted to that amount. And my dear lovable students, with regard to the second country, average rate of that foreign country is less, so rebate will be as per that country. Fantastic to the core. So doubly taxed income, you should clearly analyze, is this agriculture income, sir, 86,000, you have to read and understand, gross only they said. They have not said that in that country it is exempted. That means that country it is taxable. So in our country also it is taxable. So 86,000. So doubly taxed income is first one is agricultural income 86,000. Now dividend income. This dividend income is exempt in that country. That means I would have not paid tax in that country. I am paying tax only in India. So it is not a doubly taxed income. Only for doubly taxed income we will get the rebate. Correct? So from country second, we are having doubly taxed income of only 86,000. So 86,000 into average rate of tax in India is the lower. So 86,000 into 7.484% comes to 6436 is the rebate under section 91. Now with regard to the second country, I am going to calculate the doubly taxed income, my dear lovable students. With regard to that doubly taxed income, business loss has pulls down the taxable income. So even though I am having 2,09,300 IFHP, I have set off business loss. So 1,16,000 I have set off in India. So 2,09,300 minus 1,16,000 means 93,300 would only be taxable in both the country, because in India I have knock off this part. I have not paid tax for this. So anga maybe na tax kattirpa ana inga tax kattala. So rendu edathiliyume rendu countryiliyume tax katnadu 93,300 da. Adil average rate of tax 5% da varudhu. So 4665 is the rebate. So 6436 plus 4665 11101 is the total rebate under section 91. So from the total tax payable, if I am reducing the rebate 11,101, the net tax liability come to 75,214. Since the last number is less than 5, sir, net tax liability 75,210 is the net tax payable after claiming rebate. You know, this is a multiple country question. If you are feeling any sort of self-doubt or tension or pressure or voluminous, you just do this sum by your own, and when you get the answer for this question, automatically our confidence shoot up. And this question is a 6-mark question which is having a scope of asking 8 mark in examination, 6 to 8 mark, double taxation avoidance agreement. If you are getting the right answer for this question, don't forget to comment your happiness. Don't worry at all. Still you are having sufficient time. Every day is important. Every session is important. Cool and calmness will make a success, my dear lovable students. Any particular area you want me to revise or you want me to discuss, you just inform me in the comments. I am wishing you all the very best for the coming examination. Just pick the required thing, revise whatever you have already learned. That itself will be very huge. Here and there 1 or 2 topics if you left, for that don't break your head. This is the pattern of questions for your examination, my dear lovable students. Focus on double taxation avoidance agreement and ensure your 6 marks will meet with a new topic. Till that time.